to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
I think 2 to 3 cuts this year is reasonable. I think if the data plays out the way the Fed is expecting it to, which again, given their most recent set of forecasts, does not get us to 2% by the end of this year, I think that they will cut rates 3 times. If the data doesn't cooperate, it could end up being more like 2.
I don't think the labor market data per se, whether that's jobless claims, ADP, or job openings, or non-farm payrolls, I don't think that's too crucial, as long as really wage growth doesn't go the wrong direction.
I think Disney ought to be leading the charge to rebundle all the disparate direct-to-consumer services out there together. I think that's the biggest issue that the industry faces. We saw a little bit of that with the streaming JV, the sports JV they announced with Warner and with Fox. I thought that was a good sign. But it's a long way from getting back to a bundled product.
We've got 1 hour to go until the market close. Let's take a look at the major indexes and talk about where we stand now versus where we did just about an hour ago or even a half hour ago. We were seeing stocks really heading south here. It seems to be pegged to some comments from Minneapolis Fed President Neel Kashkari, who talked about that maybe it wouldn't even be necessary to cut rates this year, or that the Fed wouldn't be able to cut rates this year if we do not see better numbers on inflation. That is more disinflation or more sort of deceleration in inflation. Now, that is in contrast with other Fed members we've heard from, and Kashkari isn't even a voting member of the Fed right now, but nonetheless, it seems to have been the catalyst for things to move south here, down 422 points or so on the Dow right now, more than 1%. The S&P 500 also moving lower by about 0.75%, as is the Nasdaq Composite. I'm also taking a look at what's going on in the Treasury market here, where we see yields move down a little bit on that kind of commentary. And we are also continuing to watch what's going on with oil. Oil settling for the day on the Brent side above $90 a barrel, WTI above $86 a barrel. Gutting back to stocks here and looking at the sector action that we're seeing here, red across the board, broad-based sell-off here. We're seeing healthcare down, tech down as well, energy down the least with that strength in oil prices. But nonetheless, you see this is a sell-off that is across sectors, Josh.
That's right. So, Julie, all 3 major averages reversed strong midday gains after Minnesota Fed President Neel Kashkari suggested the Fed may not cut interest rates at all this year if inflation progress stalls. For more on the latest moves, let's welcome in Steve Sosnick, Interactive Brokers Chief Strategist. Steve, always good to see you. So help us think through this, Steve. So stocks trading lower here. Do we blame Neel Kashkari? Julie pointing out he's not a voting member.
Well, Josh, I think part of it is we were rallying because of optimism that Powell, was holding out the carrot. It really is almost like a carrot and stick kind of thing of rate cuts this year. But Kashkari sort of pushed back on it, and Powell didn't even say anything different in his most recent speech. He's actually had a very consistent message. It's not really what he says, it's what the market chooses to hear. I've sort of been along the lines of Kashkari and Raphael Bostic, and I believe Lisa Cook, who've sort of been questioning the idea of, maybe do we need any, maybe one rate cut here and there. And I think I tend to agree with them because it's not clear that we've got mission accomplished on inflation. It is quite clear that we've got plenty of money flowing into speculative assets. And it's not, and so that it may be premature to be holding out the idea of rate cuts right now.
Okay, and yet, as we have pushed back the number of rate cuts and the timing of rate cuts this year, equities have performed quite well, in part because it's being pushed back because the economy seems to be still growing at a decent pace. Okay, so if there are no rate cuts this year, and it's still for that reason, can equities still perform okay?
Yes, the economy, because you hit the nail on the head, Julie. If if we're not getting rate cuts because the economy is good, I'll take good economy over rate cuts any time. That was the question we came into as the year started, and I'm actually amazed that the market answered it so painlessly, was how do we get both a soft landing and 6 or 7 rate cuts? Because they're not they're not happening together. Well, we sort of seamlessly took out the idea of the rate cuts, which is fine if it's because of the strong economy. But then if you start to throw in some economic worries, if you start to throw in oil price pressures, well, that sort of sounds a little more stagflationary. It ties the Fed's hands without necessarily getting the economic boost. That's not necessarily the scenario wants to hear. We're a ways away from that right now, but I think we're seeing a little defensiveness ahead of the jobs numbers tomorrow. And after having a rip-roaring end to the third quarter, we're getting a little hangover this week.
Steve, you point out kind of the risks of cutting. What about the folks who say, listen, the risks of not cutting as well? And you know that argument, you're too high for too long, you might break something.
Oh, absolutely. There's no question about that. We certainly do have to see a strong economy to justify it, and the numbers are mixed. Every day, you get a good day one day and a bad number the next day. We'll find out tomorrow whether the job market is healthy. It's important to keep the dual mandate in mind. Stable prices, closer but not there yet. And Powell is quite among all of them acknowledging that we're not quite there yet. Things are getting better. But full employment, we're still pretty much there. I mean, yes, we ticked up to 3.9% on the unemployment. Tomorrow, we're expected to see a 3.8 tick. But anything that starts with a 3 pretty much sounds like full employment. I guess the third leg of the dual mandate, as it were, was sort of healthy credit markets and a stable banking system. But certainly, we're not seeing any of those stresses come to light. The Fed would know more about that than any of us would, because they're privy to stuff that we don't get to see. But clearly, with the amount of money going to some of the most risky endeavors, it's clear that people are not really holding back on extending credit or spending money throughout the economy.
I want to talk a little bit more about the jobs report tomorrow, because I'm curious how you're gaming that out. I mean, Powell has sort of tried to de-emphasize labor market readings. It seems like they're sort of weighting the inflation readings more heavily right now. He doesn't seem as concerned about the job market. So how do you think the market kind of reacts then?
Well, I think he's right to sort of to focus more on the stable, the prices, the inflation, because as I said, it's if you've got a dual mandate and you can check the box on one of them, you're gonna want people to focus on the part where you haven't been able to check the box. So gaming out tomorrow's number, I think we're fine if the number comes out around in line. As long as everything is more or less as expected, and I'm not going to, plus or minus, I can't really say plus or minus this or plus or minus that, but if the general reading is around as expected, you're probably okay. Too hot or too cold can be problematic. Too hot, well, you're not getting rate cuts anytime soon. Too cold, you go back to Josh's question of, wait a minute, maybe we really need these things and they're holding off.
And Steve, another potential catalyst, earnings season. We're creeping up on it, a couple weeks out. What are your expectations there?
Well, this is really the thing. Last quarter, I think we were sort of surprised at how well the market did, because we came in with high expectations and for the most part exceeded them and got good guidance. We've ratcheted it up a little bit more over the past 3 months, and so I think coming in, my fear right now, when you come into earnings season as a high, near a high, which we're awfully close to, there's a lot of good news priced in. So my concern going forward is that are we able to beat the raised bar that we've set for ourselves? Because some companies have been able to do it. I mean, you look at an NVIDIA, which is remarkably good at beating and raising and then beating again. Most companies can't do that, and I do think there's a certain amount of that is priced in, particularly in the more high-flying stocks.
I want to circle back around to oil prices also, and just talk a little bit more about how much of a concern that is for you and for the street.
One of the first lessons I was taught, and this kind of shows my age a little bit, was always be nervous when you see oil stocks lead the rally, because that's never really a good sign, because that means oil prices are going up, and that means inflation is out there lurking. I wrote a piece today, ibkrcampus.com, about how I started to, how it looks as though we might be seeing a double bottom forming in the price of crude, and how XLE, among other measures of energy stocks, has been a terrific performer. And in the last 3 weeks or so, energy has been outperforming SPX. that's not like this big waving red flag, but it's something to be concerned about because Powell keeps harping on inflationary expectations. Inflation expectations are very closely tied to the price at the pump. The Michigan one-year employment statistic for expectations is basically like a 1 month lag of gas prices, 1 to 2 month lag of gas prices. So we haven't really seen the prices accelerate at the pump too much. That's why those have been relatively quiet. But if energy prices stay high, the Fed, on one hand, they want to ignore in the PCE, they want the core deflator, which excludes volatile food and energy. Except that inflationary expectations among individuals are very heavily tied to the prices of food and energy because those are the things they spend the most on a regular basis. So it's a tough conundrum.
Yeah. Seasonality too, top of mind, Steve, sell in May and go away. You think that applies this year?
I think it's a risk. Seasonality is never never perfect, although I will say the rally literally started on November 1st. So that's definitely a consideration. This year also, it does start to coincide actually with tax season to a certain extent. A lot of people have a lot of gains over the last year. Will people need to sell stocks to be able to pay the taxes that on some of the gains they've made, or have they been holding back? We'll find that out. That's a lot of where the seasonality comes from. So you throw in April 15th. Along with earnings season, along with a calendar that's held very tightly to the seasonal biases, it's something that I think you have to be, if not heading for the hills, you have to think a little more defensively than you've been thinking over the last few months, where it's behooved everybody to play offense and play offense heavily.
Steve, finally, I want to ask about big tech briefly, because we were watching some of the big tech rally earlier today. Some of them are still up. Meta is still higher right now. Tesla, which was rebounding earlier, still, I think, has been hanging on to some gains, but Nvidia's lower. So I'm just curious how you're thinking about big tech right now and whether people should be still looking to add at these levels.
We've been the beneficiaries of this huge momentum trade. And again, a lot of it is for good reasons. A lot of the companies that have led this rally have been delivering on the top and the bottom line, which is what you want to see. Can that continue indefinitely? That's a tall order. And we've started to see a little more, I'm going to call it discrimination within the tech sector. The Magnificent Seven is not a Magnificent Seven anymore. It's a Magnificent 3.5 kind of. Microsoft is sort of moves along with the market, but Apple.
It's not as catchy, Steve. I have
no,
to say.
I could call it the Fantastic Four. That worked. That worked for Marvel
yeah.
Comics for many years. I'll throw Microsoft back in there. But Tesla's got its own set of problems. Apple, I think the market is re-rating as a value stock instead of a growth stock because honestly, its revenues are not really growing particularly fast. And so, you've got some push and pull in there, and I think that's why earnings season becomes so important because we'll really be able to distinguish who's winning, who's losing, and who's hype, because I do think there's a lot of other companies that have been benefiting sort of from the AI hype, but not necessarily translating it into a bottom line, and we'll find that out in the weeks to come.
Yeah, when we start to get those earnings. Thanks so much, Steve. Great to see you.
Julie.
I'm so glad you were here today as we were trying to make sense of all of this. I appreciate it. All right, we're just getting started here on Market Domination. Coming up, what's next for Disney after victory over activist investor Nelson Peltz? We'll discuss on the other side. Plus, mortgage rates showed little movement again this week. We'll be joined by the CEO of Compass later in the hour to talk about the latest housing hurdles. All that and more when Market Domination returns.
Let's check in on some of the top analyst calls of the day. Morgan Stanley cutting its recommendation on Block to underweight and lowering their price target down to 60. And you can see the Block really getting hit in today's trade, Julie. Morgan Stanley not a fan. How come? It sounds like, Julie, they're not so optimistic about Cash App's kind of growth potential here. What's interesting is you'll hear Block talk kind of bullishly about Cash App, no surprise, and they'll talk about how they see Cash App kind of becoming a top provider of banking services here in the U.S. But Morgan Stanley obviously not buying it, says the majority of Gen Z's potential has already been captured primarily by competitors at this point.
Yeah, I thought that was quite interesting because I think of Cash App as being something and sort of, and Square's like banking potential, Block's banking potential as being among that younger cohort. So this was an interesting call. The stock hasn't been doing very much, by the way. It's only up around 1% year to date, and that might have changed given what we're seeing today. It's up about 13% over the past year. So maybe some of this outlook is priced in. The stock has 3 sell ratings overall, although it's dwarfed by the number of buys. But, there is a little bit of a negative drumbeat on the street around this one.
Yeah, interesting too. They go on to say, given the slow development of credit products, they also kind of hammered them on that point too. It says they believe the highest value Cash App users are going to churn at an accelerating rate.
Yeah.
So their price target's 60, which of course implies a pretty sharp turn here. The average price target, we should point out, is 91.
Also, coincidentally, by the way, Mark Palmer of Benchmark emailed me earlier today to say that he has a contrarian positive call on Block, and that he says that the company has unique advantages relative to alternatives. So
very different takes.
Yes,
All
indeed.
Right.
Let's talk about Paramount because the shares are sliding today. Analysts are concerned around that potential deal with Skydance Media. JP Morgan remaining underweight and lowering its price target on the company, citing a subscale direct-to-consumer offering. It's got a $12 price target there. And the analysts over at JP Morgan are also sort of questioning the, whether this deal that we're talking about is going to indeed be ultimately successful. And we talked to Laura Martin as well yesterday, who said it does seem like a complex deal. JP Morgan says if you look at this, how the deal, as we know about it, as reported on with Skydance, would impact shares longer term depends on the strategy for the combined set of assets. And we don't know the answer to that yet.
Right. Yeah, so that's the issue, basically. Even if this deal happened, their point, Julie, seemed to be, how would, just lots of open questions, how would they actually run the business? Would they divest the assets?
Right.
And if they do, their point was that actually that could get tricky really quickly, just given how integrated some of these assets are, like, CBS Studios and CBS Network. There is an alternative, of course, out there for Paramount as a whole from our parent, Apollo, reportedly, I think it was $26 billion there.
Right.
Lots to chew over. With Disney's victory over activist investor Nelson Peltz, a proxy battle CEO Bob Iger says was a distraction, the media giant is zeroing in on its to-do list, from succession plans to a full password crackdown later this year. The House of Mouse has its hands full. Here to discuss this and much more, MoffettNathanson senior research analyst Michael Nathanson. Michael, it is good to see you. So we'll just start there with Disney, Michael. I'm interested to obviously get your take. A win for Iger, a loss for Peltz. Is it a good thing for Disney shareholders, Michael?
I think it's a good thing for the Disney shareholders because the stock has moved up so much during the past 6 months. And people are now focusing on the earnings power of this company and what management can do to drive profitability in streaming. So I think it's a good thing that this process started and is now over. The stock price is proof of that.
Your note reacting to this was, now what? And I think that's a fair question in terms of what is going to be the next. Okay, we've had all these catalysts, right, that have been tied to this fight that has sort of spurred Disney to make some changes. Now what is sort of the next catalyst?
Yeah. By the way, the title is Turn Down Now What? It's a play on the song.
Turn down for what? I was guessing that's what you were looking for.
Yeah. I thought I was clever, but I guess it didn't work. So now what is... The company needs to, as you were laying out before, I think Josh was, you need to improve the content cycle, right? So the movies have really not worked very well. They need to integrate Disney Plus more with Hulu to drive more streaming engagement. They're saying they're doing that. They need to find a defined future for ESPN, because ESPN is going to have a flagship standalone over the top product. They're selling India. There's a lot on that to-do list, right? And it's going to take some time to see the benefits of those changes. But I think they finally have their handle on addressing the issues that were, in 2 or 3 years in the making, right? So it's going to take some time, but there's a long list of things they have to fix.
Are you confident, Michael, that that Bob Iger and the board this time, or when they pick a successor this time around, they're going to get it right? I mean, as you know, that was another issue Mr. Peltz was hammering on.
Yeah, and to be fair, we didn't recommend the stock during Mr. Chapek's tenure. It was clear that some of the decisions they were making were not the best decisions. I think you have to believe that given the importance of succession right now in this company, and given all the pressures put by Triad on succession, they will get it right. It's going to be an internal candidate. I think there are 4 people who are in the the short list of the conversation. They will get it right. They'll give that person time to learn the job, and the handoff will be better than it was last time. Last time it was rather abrupt, and Bob Chapek had not spent a lot of time with many of us. I think this will be different.
Michael, I want to turn to the story we were just discussing a few moments ago, and that is Paramount, because it does seem like maybe a sale is getting closer. There are reports of this tentative deal with Skydance. As we said, we still don't know what exactly is going to happen if that deal then happens, right? Will Skydance keep the full company? Will it spin some of it off? I mean, what do you think is the most key question here? And do you think, even knowing what we know right now, that it is the right deal?
Right, so great questions. Robert Fishman covers it for MoffettNathanson, but we can talk about it. As you reported, there's a lot of confusion as to, firstly, what did Apollo actually offer and who offered it? So was that a full offer for all the company? Was it, a true offer, or just, an email or something? And then on the Skydance side, we're all trying to figure out what can Skydance actually buy without perhaps getting the independent board of directors into some type of conflict, right? So I think people are very concerned as a Paramount shareholder, if you're an owner of the non-voting stock, what actually happens here, right? So if National Amusements sells their stake of controlled stock to Skydance, it's unclear as to what does it mean for everyone else in the chain. And I think that's what people are reacting to, is that this may not be a full offer for all the stock. This may be for the controlling share. So, this has been a very public but uncertain scenario, right? There's a lot of public disclosure, but even this late stage, it's uncertain, unclear what they're bidding for and who's bidding for what. So, we're basically, we turned neutral on the stock. We were very negative, as JP Morgan was, as you said, a seller, but we were worried that because of the potential for a takeover, the stock would be supported by those rumors, right? So fundamentally, they're in a tough position. And we're still waiting to find out actually what this offer is and how do the shareholders get, benefit from this, aside from National Amusements.
Another name I want to get your take on, Michael, off a headline today. Google, Reuters reporting, I'm sure you saw this, Google has talked with advisors, potential offer here for HubSpot. Does that make high-level strategic sense to you, Michael?
I don't know enough about it. I've always deferred to, when it comes to Google's M&A, they're highly targeted, right? They do not do large deals. Their engineers are best in class. If they see an opportunity, I've always deferred, look, whatever they think makes sense, it's hard to challenge their track record and their knowledge. And these deals are never that dilutive because it's such a large company and they're sitting on so much cash. So I would say that is a less of a concern to me than almost any other type of M&A I've seen in my career.
Well, Michael, while we're talking about Alphabet, you had out a note on it recently, a few days ago, where you sort of revisited your thesis about it being this media giant that is still somehow sort of underestimated as the owner of YouTube. And it's true, we don't talk about it as much. We also have been talking about generative AI mostly as it relates to search and less as it relates to something like YouTube. And I'm just wondering what you think the opportunity is there, if there are things that we're sort of missing on that front.
That's a great question because in generative AI, what will happen is it will open up the ability to create great content for more people at a lower cost. And I think it's going to be revolutionary in terms of what the average person will be able to do. And YouTube would be the best discovery platform to find the best in user-generated AI. So I see a potential sea change in the quality of user-generated content that will be coming. And YouTube's done a great job of cultivating these creators. And I think YouTube will benefit as more content becomes democratized through AI. So it's something we don't talk about because it's so early in the development. But I think YouTube will be one of the winners of the AI revolution that's coming.
Michael, it was great to have you on the show today. Thanks so much for joining us.
Thanks for having me. Appreciate it, Josh.
Now, as we head to break, take a look at the market action. The selling accelerating here into the close, now near the lows of the day. Dow on track for its fourth straight losing day. We're tracking all the market action here. Plus, Grindr has been feeling the love as of late with several upbeat coverage initiations in recent days. We're going to speak to one of those analysts about the dating app on the other side.
Dating app Grindr getting some love from Wall Street with several upbeat coverage initiations in recent days. Among those, Citizens JMP Securities, starting out with a market outperform rating on Grindr. For more on what's making this an attractive opportunity, let's get to Nick Jones, Citizens JMP Equity Research Analyst. Nick, it's great to see you. Thanks for being here. What has been interesting to me in some of these initiations, yours included, is that the Grindr customer base seems like it is more perhaps loyal or has more potential than sort of the bigger dating pool, if you will. Can you talk us through your call?
Yeah, I think that's right. The LGBTQ community, and this app really focuses on gay men, has largely been underserved by mass appeal dating apps, even if they're casual dating apps. So this app specifically is a place where these folks can find a community that otherwise was difficult to find, whether it was on Meta, on Facebook or Snapchat or Instagram or TikTok. Over the years, this has kind of been a ubiquitous platform for the LGBTQ community to find each other, connect for dates, and people even stay on here as friends after they've connected on the app. So it's a really compelling brand within kind of the online dating and even to a lesser extent social media landscape.
And Nick, you look at the stock, it's had a nice run. It's up about 70% here over the past 12 months, but you must think valuation still looking attractive here?
Absolutely. I mean, they are growing revenue 100% faster than the next closest dating app. Their profit margins are industry leading. They are under monetizing their user base. If you think about monthly active users on a dating app, often about 15% of those get converted into paying users. For Grindr, they're only at 7% today. So they could double that just on the current user base, let alone their ability to continue to grow the user base in the US and internationally. So we think there's plenty of levers for them to pull to continue driving revenue growth and being quite profitable.
It is interesting. We recently spoke with the CEO of Grindr, and he talked about this idea of expanding sort of beyond dating, right, and offering some other services. What do you think is promising on that front?
It's really early to say, but, they've gotten a little bit into kind of fitness and healthcare. They're constantly adding kind of health awareness type features, whether it's for HIV awareness and things like that. I mean, I think the sky's the limit. I mean, what's important for an online business is to have a highly captive audience, and Grindr has that. So I really think they have a lot of options, and they're in the driver's seat with this audience.
And Nick, do we have any kind of line of sight into what this company's plans are when it would come to AI? Do we know there? They certainly have a ton of data, Nick.
Yeah, it's really early to say what's going to come, but every company is deploying something, whether it's going to help with improved or better matching. For dating apps, deploying AI into improving the safety on the platform is always a focus for all dating apps. So I think they're going to deploy it all over the place. Most companies, what we've heard, are really focusing on internal processes first, really before they get comfortable pushing things out to consumer-facing solutions. And
Nick, final question here. So you initiate, you're a fan. What are the risks to that call, though, that viewers should think about?
Well, the stock does have relatively low liquidity relative to kind of maybe the largest stocks out there that everyone's familiar with, the usual suspects, FANG. So relatively lower liquidity. But outside of that, we view this as actually a pretty strong company here. You don't see many companies growing over 20% revenue growth with north of 40% EBITDA margins, whether it's SaaS or in internet stocks or e-commerce. So we think there's relatively low downside here. Really with just their ability to execute on improving monetization, driving payer adoption, et cetera.
Nick, thanks so much for joining us today. Appreciate it. Mortgage rates hover in the 6 to 7% range with no signs of a meaningful decline, at least in the near term here. Affordability, a sore spot in the housing market as prospective home buyers look to the spring buying season. Here with the very latest pulse on real estate, we have Compass founder and CEO Robert Reffkin. Robert, good to see you.
Glad to be here. Thanks for inviting us.
So spring selling season, what are you expecting? Should we see a big jump in inventory?
Yeah, so at Compass, we have a very unique perspective. We're the #1 brokerage firm in the country. We have over 30,000 agents. We're in every major market in the country. What we see is 26% more inventory today than the same time last year, which is great because more inventory equals more sales. Last year was defined by sellers sitting on the sidelines, and it translated to the lowest level of transactions since 1995. So we feel like we're in a much better place now. And last week, we actually saw 13% more homes under contract than the same time last year.
And that's really been one of the bottlenecks, at least, right? Has been the amount of inventory. I'm curious, so it's up 26% from last year. How does it compare to the prior year or prior years? Are we still a pretty far cry?
I'm glad you asked that question. For context, we're still 40% below the pre-pandemic level of inventory. This country just doesn't have enough inventory.
And Robert, with the 30-year fix where it is, how much of a headwind is that for the market?
It's a headwind for both buyers and sellers, but really more for sellers because a year ago, we had 72% of homeowners locked in at 4% mortgage rates or below. So the difference between a 3 and a 7 is just too far off. Fortunately now, it's about 58%. So it's going down about 1% a month. We call it that lock-in effect, locked in from selling their homes because of their low mortgage rate.
How does it, can I just ask real quick, how does that impact sellers though, Robert? I mean, what, does that impact pricing, for example?
It impacts their willingness to sell. The sentence you'll hear from sellers is, I have a 2.5% mortgage rate. Nothing would get me to sell my home. But there is, there's a dynamic at play. We call it the 5 Ds, diapers, diplomas, diamonds, divorce, death. And that keeps the market moving, those life events. And so those life events are what bringing the 72% down almost 1% a month to what we now have around 58%.
And yet, maybe that mortgage rate is vying with those life events. I mean, we saw a recent study from John Burns Institute that they survey people regularly on what are the things that is holding current homeowners back from purchasing a home. And they said for the first time ever, waiting for mortgage rates to decline was actually higher than those life events. So what is going to change that? Is it that those rates are going to start to decline?
Well, I think the Fed lowering rates would do more for the real estate market than anything else. Right? That's the biggest bottleneck because 7% is still pretty high from recent history. It's low from a 30-year perspective. There are a lot of agents at Compass who say, I remember when mortgage rates were 20%. But we are hopeful that rates will come down to the low 6s at some point this year. I think the magic number to completely open up the market would be high 5s and maybe even 6, because the last fall we saw 8% mortgage rates. And so in a way that was hard last fall, it really slowed down the market. But from this perspective, it's great marketing, 8%, that 6% mortgage rate is a great deal.
And Robert, who's buying a home right now? Do you have like sort of line of sight into that? Because it's hard to imagine. Tell me if I'm wrong. That it's a lot of people in their 20s, just given the affordability issues we're kind of talking about here. Has sort of the American dream kind of been pushed out here a bit?
We absolutely have affordability issues in this country. However, the very nature of having inflation means that there's a lot of money out there, and what we're seeing is people are buying across ages, across geographies, but the hottest markets are the markets where the employees are paid in tech stocks. So San Francisco, Seattle, where you're paid in Amazon stock, Microsoft, Facebook, et cetera, where it's at an all-time high. Yeah, you don't need a low mortgage rate if your stock portfolio is at all-time high. New York's benefiting from that a little bit with Wall Street, as well as some of the other tech hubs.
I have to ask you about the settlement, that is going to change, we think, how buyers and sellers are paying their buyers and sellers brokers, because that's something that could affect Compass. I think everybody's trying to figure out how. And so as someone who runs a company that this is going to affect, but it's an uncertain outcome, how do you plan for this? What do you think is going to happen?
Yeah, look, I think the headlines have been much more dramatic than the details of the actual requirements. There are headlines that say NAR eliminates the 6% commission. NAR doesn't even govern commissions. And so there are 2 changes, only 2. I think they're fair. One is that the MLS website, just a website, will no longer be able to hold the commission that is paid to the buyer agent. And the second is that buyers will have to sign a buyer representation agreement with their buyer agent. So I think it's not as dramatic as the headlines have described, and I don't think things will change as much.
Do you think, Rob, this could impact the pool of realtors out there? Because I've heard some people make that argument. Maybe you'll see fewer realtors because of this.
I think if you are thinking about becoming an agent and you read headlines and you're thinking about becoming an agent in the next 3 to 6 months, you may decide not to. So maybe you get less people coming in. I think if you're an agent and you've been doing this for less than a year and you see the headlines, they scare you, you may leave. But if you are a professional agent, I don't think there will be any professional agents who leave the business because of this.
Well, and is there also an opportunity, if there is going to be more negotiation between a buyer's agent and buyers, is there also an opportunity, if you are an amazing agent, to outperform even more than in the past? Or I'm still trying to wrap my head around all this in full disclosure.
Yeah, no, look, it's a good question. Commissions have always been negotiable. And so from that perspective, they'll be able to negotiate in the same way they have in the past. But I think to your point, if you're an agent and you think that your services are worth more than others, yeah, I think this gives you an opportunity to say, I think I'm worth more, and my services cost 3+%. And I do see that in the market. Agents independently come up with their commissions. There is no standard commission out there across the MLS. You can look in the MLS. There's all kinds of permutations. And so I think you are right that you may see some truly great agents, just like truly great lawyers, truly great doctors, command a higher commission than others.
Interesting. All right. Well, to be continued, I'm sure, as this evolves. Thanks so much, Robert. Really appreciate your time. Still to come, we're taking a look at the best way to play the broadening market strength and protect your portfolio in today's investor playbook. Stay tuned. More market domination on the other side.
Stocks selling off in late day trading here. Jared Blickery has a closer look at the market action. Jared.
You can see it right behind me. Picture worth 1,000 words. We are in the midst of a sell-off. Not a lot of green, although notably Meta and Tesla, two of the mega caps, are actually in the green, each up over 1%. But that is the aberration. I just want to show you the quick sector action, everything in the red. To the downside, we have leading the mega cap sectors plus healthcare. XLV is actually the worst off. XL that's tech that's close behind, and then communication services also underperforming. Real quick, want to just show you what's happened over the last 4 days, because March 28th was a top here. And in that time, we've seen energy and communication services, thanks to Meta. Those are the only ones in the green. And we've seen healthcare take a nasty stumble. As I said, that's the worst off today. Real estate, consumer discretionary, and staples also doing poorly. But let me show you what happened today. I think this is worth a lot more words here, too. This is U.S. oil. This is my WTI crude proxy. That is in purple. So that's that purple line that ends at the top here. That is versus the Qs. That's the Invesco Nasdaq 100 ETF. And as we saw that oil was bottoming, we saw tech stocks take a turn down, and somewhere in here, Neel Kashkari is warning about no potential for no interest rate cuts this year. Bottom line is we're having the worst day in the indices in several months.
We'll see if that stands to the close. I mean, we only have, 11 minutes left. Thanks so much, Jared. Appreciate it. Well, as stocks slide in today's session, we're taking a look at the best way to play the market and to protect your portfolio within ETFs specifically. Joining us now, Ben Slavin, BNY Mellon's Global Head of ETFs, and Johan Gran, Allianz Investment Management Head, ETF Market Strategist. Gentlemen, thank you so much for being here. Ben, I want to start with you because we are seeing a little bit more turbulence in the market today, and really we have been all week as investors take another look at what the outlook for the Fed is and try to figure out how to trade around that. So sort of on a macro basis, how are you thinking about that strategy?
Well, first of all, it's great to be here. And ETFs are once again having really their second best quarter ever. We took in about 200 billion in flow from an industry perspective, which is quite impressive. But also the breadth of product that we're seeing attract inflows is also quite large, where over 1,500 products just last month took in flow. Some of that flow we're starting to see go into actively managed ETFs, which are clearly punching above their weight class. It was a record quarter, around 64 billion for actively managed ETFs, which is about 30+% of the flows, but they're only 7% of the assets of the whole industry. So clearly, investors are looking to some active management to navigate this part of the market cycle for sure.
Johan, same question to you. Kind of start with just your top-down view, Johan. What are the big trends and themes you're seeing in the world of ETFs?
Well, so we look specifically and more on the niche market that is really part of the broader market. We have an acute focus on the defined outcome space. So what that means is that you have a structure in place inside of an ETF. And it's a space that it's relatively new. It's been around for maybe about 5 years or so, give or take. And it's grown basically from zero, and now it's just now recently breached, the $35 billion level. There's over 200 funds that have come into this space now, and we can get into the weeds on that if you like. But it's really more like 50 different strategies that you can invest in multiple different tranches. So it's a way to get market exposure to the broad indices, but at the same time you provide a little bit of a safety net underneath of you, and then you give up some of the returns on the upside. But there are some very unique trade-offs that I think are worthwhile taking a look at.
Well, and Johan, just quickly to follow up on that, do you tend to see demand for this kind of product as performance agnostic of the broader market? In other words, one would think that when stocks are a little rockier, maybe people would be taking more of a look at that, but I don't know if that's the case. You tell me.
Yeah, I mean, it's the good old, you look in the rearview mirror and you say, ooh, that hurt. And you say, at this point, I want to put the Band-Aid on. And, as well as I do, it's too late, right? There's tons of analogies that we can throw around on that topic alone. But the growth in this part of the industry is really more about growing education around this topic and growing understanding for how these types of products work. They are the first of a kind in that you can create a structure inside of an ETF that is truly liquid, so anyone can buy into these types of products. And it's something that hasn't been around for all that long, but this is a really good way for you to think about how you can massage the correlation benefits that you used to have in fixed income and equities in the past that no longer really quite exist. And it also gives you a level of confidence in how you can invest, because you always know what the parameters are before you put your money into these ETFs.
And Ben, back to you. I want to touch on your thoughts on actively managed ETFs. Just dig a little bit more into that, Ben, because what you point out is you're seeing sort of this growing traction there of those products. How come, Ben? What explains that?
There's lots of different reasons, and certainly the types of products Johan was just talking about are about risk, right? Investors are trying to make sense of this market. We have stocks, we have gold, we have Bitcoin at their all-time high, but we also have 5% Treasury yields. And this is why we're starting to look at investors playing this market in different ways. So one is certainly to take a more defensive posture. And we're seeing that in these option income or different products that use options to provide, whether it be income or some kind of a market hedge attached to it. But also we're seeing flow start to move into the quality ETFs, whether they be active or some factor variety that's really trying to, again, play not only some of it to be a little more defensive, but also look potentially at some mean reversion. I mean, we saw this tremendous run up in the Mag 7 stocks, and index concentration, again, is another issue for investors and advisors as well, trying to look at, again, providing some diversification and a way to play these markets. And again, ETFs offer a variety of tools to do that. So active, clearly part of the story. And then also some of the more factor-based ETFs, looking to, again, play some of those lower valuations or take a more defensive posture to some degree in this market, even though it's hard to, conceive of at this particular point in the cycle, given where markets have been this past quarter.
And then, Ben, we've also seen a lot of interest in small caps. We've heard a lot of people on this show talk about how they like small caps right now. What are you seeing in ETFs when it comes to small caps? And do you expect those types of flows to continue?
Yes, certainly small caps are one space we're starting to see a turn. Now, clearly they've underperformed the last quarter, but we are starting to see through our own data. And we have a distribution intelligence product at the bank called Growth Dynamics, which provides really an incredible amount of distribution intelligence across all of the different platforms, including Pershing and many of the major broker dealers. And we see small caps starting to catch a bid and attract some money from investors. And it's a little bit across the board, certainly passive. We also see active product. And also I mentioned really some smart beta products that are really trying to isolate different factors inside small caps are all starting to attract attention. But you have to think this is a little bit of a mean reversion trade, given the underperformance of small caps, especially recently. But the data shows that money's in motion there.
And Johan, I want to bring you back in here. Listen, we're talking ETFs, Johan. I need to get your perspective on those new spot Bitcoin ETFs. I know you're not an expert there, Johan, but what do you make of those products? What do you think the proper role of those products, Johan? What is their role in someone's kind of investment portfolio?
Yeah, I mean, unless you're buying Bitcoin ETFs as a pure gamble, then the position in the portfolio would be one of correlation benefits. You might want to slice an allocation into your overall portfolio to gain some diversification benefits. But the hard part there is, what kind of size do you actually buy into and what kind of allocation are you looking for? Because the more you put in, the less of the correlation benefit you get, because that's getting chewed up by the volatility of the underlying investment, which in this case, we're talking about Bitcoin ETFs, right? So yeah, it might play a role as a diversifier, but I would favor something that could give you more certainty around what that diversification looks like, that you can allocate a larger proportion of your assets to. And if I can make one more note on the space that we talked about earlier, there's a new evolution of this space, a new type of structure that gives you 15% downside protection against market drops, which is something you need, for example, when you're retiring or when you're in retirement. It gives you an immediate safety net on the downside. And then it's uncapped on the upside after the market has reached a certain threshold, like 3% in this particular case. That allows the investor to participate over long time periods in the most the most aggressive returns that the equity markets turn out. So keep in mind, like if the average on the equity market might be 10%, give or take, you really only get to 10 by capturing those 20 and 30% years as well.
Johan, Ben, that was a great discussion. Thank you both so much for joining us.
Always a pleasure. Thank you.
The stocks continue to sell off. The Dow now down roughly 500 points. Don't go anywhere, because while we're wrapping up today's market domination, got you covered with all the action following the closing bell.
There's the closing bell on Wall Street, and now it is market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's session. We see stocks ending near the lows of the day here for the Dow. That means a drop of 530 points, give or take, down 1.4% here. I also was looking at how we're setting up for the week, and it's not pretty. Down 3% for the Dow here as we head into Friday. It seems like there's a lot of trepidation around tomorrow morning's jobs report after we got some commentary from different Fed officials over the last few days. The one that really stood out from today was Neel Kashkari, not a voting member of the Fed, but pointing out that maybe a rate cut this year won't even be necessary if we don't see inflation start to decelerate. The S&P 500 on the week down 2%, on the day here down about 1.25%, and finally the Nasdaq Composite, the underperformer of the day by a hair over the Dow, down 1.4%, and for the week down about 2%. I don't know, Jared, I don't know if you know off the top of your head, but I'm guessing it looks like the worst week for the Dow in quite some time, on track for at least.
Yeah, I wouldn't doubt that. Worst day in the Dow and the S&P 500 probably since about mid-February. Let's show the Wi-Fi interactive here. I'm going to move on to some heat maps in a second, but I want to show you what's going on with the VIX because volatility is elevated. You can see that. Here's a 4-day look. This is that big spike up, and if we take a look at a 2-year chart, we can see, well, it's still in the bottom end of the range, but it's picking up, and we can see this kind of broadening megaphone pattern here, which we've seen before. So we could see some higher highs and some spikes. So volatility expanding probably is coincident with lower stock prices across the board. Now, this is an intraday look that we have here, and everything closing in the red today, although energy, the least dirty shirt in the laundry basket, thanks to higher crude prices, that is the least bad off. But tech taking a tumble, down 1.58%. That's large cap tech, then healthcare, then communication services. All in all, is pointing to a pretty red tape. Let me just show you ARC Innovation Fund components. This is the disruption trade. That's looking pretty red. But I did want to show you one green screen here, and this has to do with defense, because we are seeing Middle East tensions on the rise. We've seen that reflected in crude oil prices, and here we are seeing defense decidedly green here today, Josh.
Thank you, Jared. I want to look at one name today, which actually managed to finish the day in the green on this down day, and that is Meta. In fact, hit a record high in today's trade. Our buddy Brent Till over at Jefferies has a new note out, likes what he sees. Based on his analysis, says Meta could capture 50% of incremental industry ad dollars in 2024, which would be its highest ever, he said. So look for market share gains to further accelerate. That's his point this year. Also did call out Gen AI, of course, music to every investor's ears. Julie, we know that. Brent's saying his checks again indicate early tests of Gen AI ad tools are now driving some meaningful improvements in click-through rates. Bottom line, he had a buy, he sticks with the buy, takes his price target up to 585.
Yeah, and like you said, he's been bullish, so it's just that he's getting a little bit more bullish. Yes. And it's unclear to me if this is the only reason why the stock was rising in today's session, but it is interesting that it resisted the pull downward that we saw more broadly as the day went on. Some of the other stocks that had been attempting to rally or to rebound within the sort of legacy Mag 7, large cap tech, whatever you want to call it, did not end up higher.
You know what did end higher also? Tesla.
Oh, well, there you go.
Nice little pop,
held on to its gain. All right, well, the Dow extending its sell-off to a fourth day in a row, longest losing streak since October. Yahoo Finance head of news, Miles Udlin, here with his takeaways on the day. I mean, you know, I always jinx it, Miles, because I wrote earlier in this week in the morning brief about how the fundamentals hadn't really changed, even though we were seeing some spiking bond yields. But I don't know, there's a lot of questions, it feels like, this week.
Well, I feel like today's action shows the market in kind of a fragile state because you have, I mean, to me, going back over, you know, my history covering financial markets, it feels like Middle East tensions, geopolitical tensions of all variety are cited when there's these days that things move a little bit more than you thought they would. And I mean, there is material news, obviously, out of the Middle East today with, expected attacks from Iran. You have the president coming out, offering his view on whether there should be a ceasefire in Israel, or in Gaza rather. So there's all of these different components to that. It's not like it's a total nothing trade, but to see the market act the way it did overall feels to me that the market is in just a little bit of a heightened state, because the other side of this is you have Austin Goolsbee and Neel Kashkari, two Fed presidents, regional Fed presidents, coming out and offering their views on inflation and rates and all this, where they think things are going. And, you know, with respect to both of those men, normally wouldn't be huge market movers, but both of them together today saying things that markets really seemed to listen to, and it just added into a pretty jumpy picture, especially if you look at, the intraday chart. Bad markets act bad after 2 p.m. We saw that, in all fragile states of the market, 2022, it's like, that's the way that it goes. You see this cascade of selling into the close. And so for that pattern to hold today, I think shows, again, a lot of unease out there on the street.
Yeah. Geopolitics, you just reminded me, though, Miles, that Ed Yardeni this week, and he remains bullish. But I thought it was interesting, he told his clients, the one big risk, if he had to put one bullseye on it, is geopolitics. And he said this earlier in the week to his clients, that he does look at Israel and Iran, and he thinks there's greater risk of tensions ramping there and disruptions to the oil markets. So it was interesting how strategists trying to game that.
Yeah, I think, for investors too, there's a huge lack of control when it comes to that stuff relative to, how Fed speakers are behaving or what Fed speakers are reacting to. I mean, I think there's a lot of market participants who believe that, you saw it in the beginning of the year, the way the market priced in interest rate cuts very aggressively, and the Fed kind of held steady, and they kind of agreed, let's say ahead of the March Fed meeting, okay, we can hold on 3 for right now. There's an interplay between Fedspeak and markets, and I'm not really sure that holds when it comes to Secretary of State or heads of state meeting or various militaries making strategic decisions. It doesn't work quite the same way. And so that's why I think it's always that perpetual risk. We all know from all these different folks that geopolitics is that unknown because markets really don't feel like they could exert any pressure on any entity, though they might try.
And yet, markets largely shrug off geopolitical tensions, aside from sort of blips like this, right? Usually, it doesn't have a lasting effect unless and until it has an economic effect, right? And so, to your point, though, geopol wouldn't be an issue. Kashkari and Goolsby wouldn't be an issue if there wasn't some underlying fragility in the market. And it's not a coincidence that tomorrow morning is the jobs report, right? And we're going to get another piece of data.
Yeah, I actually, though, as you're talking, though, I think it's what you wrote earlier this week that is the underlying tension. I think the jobs report's like, take it or leave it, to be honest. But the move in yields is the underlying tension. I mean, it all comes back to what is your cost of capital for a company, for an investor, what's your hurdle rate? And as Treasury yields go higher, it challenges all of those assumptions. I mean, we were sitting here 2 weeks ago talking about how great the debut was for Reddit. IPO windows open, let's go, get it going. Every investment banker is fired up. And now your cost of capital is way higher. And that is a challenge on all kinds of assumptions, which create the conditions in which geopolitics is now a problem, Austin Goolsby is now a problem, et cetera.
And one more thing I want to point out that Jared put in our breaking news channel a little while ago, Investment Company Institute saying money market assets hit a record in the week ending April 3rd, $6.1 trillion. So it's also the competition for assets, right? If I'm worried about geopol and I'm going to put more of my money in a money market because rates are also remaining high, maybe I'm not going to put as much in stocks or in risk assets.
Yeah, and I think there is also plenty to be said. I mean, it is a cliche, but cliches exist because they are true, that after a quarter in which the S&P's up 10% and everyone's all happy, where's the marginal bid in the first week of April as companies enter earnings season? I mean, markets are made on the margins. Is there a huge bid for corporate buybacks this week as you're sitting with your IR team prepping earnings? Probably not in the same way there was 2 weeks ago. And that's the stuff that can move the modern market, which is mostly passively driven. That's, you can see a 3% fall on what feels like nothing, but there's a little something there.
Miles, thank you. Appreciate it. Slate of Fedspeak taking a toll on the markets. Joining us now is John Villas, BNY Mellon FX and global macro strategist. John, it is good to see you. So let's just dig in right there. On the Fed, John, central bankers, our policymakers continue to speak. Neel Kashkari's comments certainly made some headlines, John, saying, listen, maybe no cuts this year if we don't see progress in inflation. What did you make of that?
I think they're being a little overrated in what happened in the overall afternoon action. I mean, Kashkari has been very much to the hawkish side of the spectrum, and he's really kind of stating the obvious. If inflation doesn't come down, we're not going to get cuts, and that's the name of the game. And I think Messer put it right, and Goolsby, we need to see housing and non-housing core services come down. So I think inflation is still the name of the game. I do think there's some signs the job market's slowing. So I'm not sure Kashkari is necessarily the catalyst for what's been going on today. And I still think we're 50-50 for a June cut. I'm leaning for a June cut because I do think the inflation data will give them enough readings to be comfortable doing so.
So if not, then Kashkari necessarily, do you ascribe it to geopol, as we were just talking about, geopolitics headlines today? Do you think there's some underlying other things going on in the market here?
Yeah, I was listening to your discussion on the lead-in, and I thought it was very good. You kind of encapsulated it very well. Bonds were sort of oversold. There are some geopolitical tensions that have come, kind of gradually throughout the day. And some of those high Mag 7 names were overbought, and time for people to sell some stocks and buy some bonds. Saw the dollar rally a little bit. I think there's geopolitical risk in there. Kashkari didn't help, but I don't think he's the main catalyst for the afternoon's action.
John, going back to something you said, so you're looking for a June cut, and you see inflation continuing to moderate back down to that target. How come, John? Because we've had other guests on the show who said, they're actually maybe a bit more concerned about inflation, that it looks kind of like a bit sticky to them here.
I understand that, and I think we're still kind of scarred by the January data that was printed in February and some of the February data that came out. I'm really keying on core PCE, and within that, the core PCE X services number. Housing is gradually declining in line with rents on the street. So that's giving, it's going in the right direction. Goods are essentially at zero annual inflation. And it's that somewhat sticky one that's finally peaked its head below 4%. And the monthly increase in February was only half that of the January increase. So I'm expecting that if we get more readings like that they'll be covered a cut, because we do think the labor market is going to show some signs of weakness. Maybe not in tomorrow's headline number, but we're looking at a broad number of things.
Well, John, I was going to ask you what you're looking for in tomorrow's number, what you're expecting, and which sort of part of the report you're going to be paying the most attention to.
Two things. Obviously, the unemployment rate will grab a lot of attention, as will the headline NFPs. But I really want to see where the job growth was. We've seen it primarily in two sectors, and that's government and medical care services employees. And those are not cyclical sectors. Those are ones that tend to increase almost secularly. So if you take those guys away, we have much fewer non-farm payrolls being generated ex those sectors. Now, I know we can play the X game forever, but my point is, the other thing I'm going to look at is household unemployment. That's increased quite a few of the last several months, and I'm careful to see if new people who are coming into the labor market are indeed not finding jobs. So those are the two things I'll look at under the surface tomorrow.
And John, you do have FX responsibilities there at BNY, so I'm just curious, John, to get your broad view on the dollar here.
Well, aside from today, if today's geopolitical concerns don't bubble over and become a longer run thing, I think the dollar will weaken. It weakened actually this morning a bit when the initial jobless claims were a little higher. It weakened on sort of Mester's comments as well. I think if we do get the June cut, as the market gets closer and closer to do that, and it's going to take the data, I concede, but I think the data are going to go in the right direction, then I think the dollar will start to decline a little bit, not massively, but sort of reflect that finally priced in cut that's getting closer and closer. After that, I think broad long term, second half of the year, let's say, I think the dollar will return to a seat of prominence. U.S. will continue to outgrow its peers. The Fed won't be cutting rates as much nearly as the other central banks will. And I think U.S. growth will outperform China and Eurozone. So it's sort of a little J, nothing really major in the downtrend, but probably a stronger dollar once the cuts start to happen and other central banks join the game.
Interesting. All right, John, thank you so much for your perspective. Really appreciate it.
Pleasure.
Coming up next, women coming back to the workforce in a big way. We'll tell you about it when Market Domination Over Time returns. Women are coming back to work in a big way. According to the Bureau of Labor Statistics, female labor force participation hit an all-time high last year, recovering major ground after a pandemic-era pullback. While they still make up less than half of the total U.S. workforce, women's participation is broadening out to bigger roles and new industries. And joining us now to discuss, Kate Duchesne, the CEO of consulting firm RGP. Thanks so much for joining us, Kate. So what do you think are sort of the major factors that have been fueling this return to work?
Well, I think the biggest factor is that there's more flexibility in how work can be accomplished, meaning either remote work or more flexible schedules. And certainly the use of technology and digital tools has helped create more flexibility in the delivery of work. And women benefit from that, especially having left the workforce during the pandemic when they needed to care for others in the home many times. And now that we have new tools and new hybrid work policies, it's really encouraged women to come back.
And Kate, when we say women are re-entering the workforce at this record clip, which women, Kate? What are the demos in terms of age, race, socioeconomics?
So it's educated women. So let's talk about that for a minute. I think, Julie, you just shared that women still are below 50% in overall participation. But when you look at the stat of 25-year-old women and above with college degrees, women actually make up 51% of the workforce in the U.S. Certain demographics and disadvantaged populations are seeing less growth than that, but still showing improvement.
Kate, what effect are we seeing on the sort of backlash against DEI programs on female and minority, for that matter, workforce participation? Is that having an impact? Is that pushing things down at all?
We're not seeing it yet. You did reference that female participation was at an all-time high last month. This latest month has only dipped down by a very small degree. So I don't think we're seeing that yet, but that is a risk factor that I think we have to pay attention to. In more conservative economic environments, some of those programs tend to receive pressure, but they're still so important to ensuring that we have the talent and the skill sets we need in today's very disrupted market.
Well, and Kate, I'm curious what you're hearing from your clients on that front. Is there still that appetite for diverse workforces, whether it be gender or other types of diversity?
I think the answer is yes, and it's really driven by what's good for business, and aligning what's good for business and also the core values of organizations. But when you look at what's good for business, bringing women back, especially women with college degrees that can move into financial management positions, project management positions, HR related. There's so much happening in workforce transformation in today's work environment. All those skill sets are really needed because of retirement pressures and professional choices that incoming talent is making, especially, say, in the finance and accounting arena, where we can't get enough new college graduates into those professions right now.
And Kate, I'm interested, what role does hybrid work play in the discussion we're having?
I think it plays a big role. Still, I think in a recent report of the Fortune 500, hybrid is definitely the prevalent work style of today, meaning 2-3 days in the office. And that seems to suit a broader population of talent, including women, and gives one more flexibility in how work is performed. So I think it plays a big role. I think hybrid is here to stay. I think the implementation of hybrid means different things to different companies, but having that element of more flexibility, and certainly where talent can deliver around the world. I mean, what we're seeing is this talent population. It's not just North America centric anymore. We're really seeing a global talent pool.
And Kate, you've mentioned a couple times, it's interesting to me, hybrid work obviously is something that only certain people can do by the nature of their jobs. You also mentioned that it is more women with higher education levels that have returned to the workforce in higher numbers. Where does that leave other women, right? Women who are in jobs that are hands-on jobs who don't have as high education levels? Because it seems like maybe they have more ground to make up.
Right. Well, I think a good example, and this is not less education, but we all know what happened during the pandemic in the nursing profession, which is largely dominated by women. And what we've seen following the pandemic is that many women decided to change career focus and leave some of those professions that required more on-site delivery and move into, I mentioned project management before, but there's been a real uptick in project management participation by women, and especially at the leadership level. I mean, women have great multitasking skills. We tend to manage many constituencies in our life, and so those skills really match up. I think, though, Julie, your point about needing to upskill in order to get the opportunities that one wants that fits into both life and work is really important. And if you're not willing to invest in that learning or upskilling, your choices will be more limited.
Kate, thanks so much. Important conversation. Thank you for joining us.
You're welcome. Thanks for having me.
Now here's a look at what to watch tomorrow, Friday, April 5th. The March jobs report is finally here. The expectation is for the economy to have added 215,000 jobs last month, and the unemployment rate edging lower to 3.8%. The labor market data are some of the key economic inputs for the Fed's decision-making and the path to cutting rates.
It's also another busy day for Fed speakers. Federal Reserve officials Susan Collins, Tom Barkin, Lori Logan, and Michelle Bowman all expected to deliver remarks on Friday. And it comes after Thursday's series of speeches took a toll on the markets. Minneapolis Fed President Neel Kashkari suggested the possibility of no rate cuts this year.
Meanwhile, Treasury Secretary Janet Yellen will be speaking to the U.S. business community in China. Secretary Yellen to deliver remarks on the bilateral economic relationship. In China, Yellen is also extending bilateral meetings with Chinese Vice Premier He Lifeng.
Turning to tech, Apple supplier Foxconn will release sales numbers for the month of March. That could provide some insight into, in turn, what's happening at Apple.
Coming up, another crude awakening for drivers as gasoline prices in the U.S. hitting the highest level in 6 months. Today, we're going to chat the latest on the other side when market domination over time returns. The March CPI report due next week, and we've been watching egg prices closely here at Yahoo Finance. After a bit of a reprieve, prices could be back on the rise. Brooke DePalma is here with the details. Brooke.
Good afternoon, Josh. Good afternoon, Julie. Eggflation back in the news here ahead of March CPI out next Tuesday. And what we're really seeing here is cases of the bird flu are seeing an uptick here, impacting poultry producers, impacting egg producers here. And based upon the previous month's report, February's CPI data, egg prices were down 17% year over year, but month over month, they were up slightly 5.8%. And of course, when the bird flu impacts these flocks of egg-laying hens, we then see prices of eggs jump. And if you take a closer look at a price of a dozen large grade A eggs, in February 2024, they were $3. But back in February 2019, they only cost about $1.50. So we're nowhere near where we were back in January of 2023 when we saw a huge impact from the bird flu. Back in January 2023, egg prices were $4.80, but many saying here, should this bird flu continue to spread, we might see an uptick in prices there.
I mean, does anything cost what it did in February 2019?
Right, I wish, Julie.
Especially at the grocery store, I think there is nothing. We heard from CalMaine this week, and they gave some big numbers as to the effect that the flu is having so far.
Yeah, I mean, certainly they've had to close down one of their facilities on Tuesday. They shared that their Texas plant did test positive for the bird flu. That impacted 3.6% of their total
They killed 1.6 million birds.
Yeah,
that's, I mean, let's talk about the number of...
That's daily what they have to do when this bird flu impacts one of their facilities. Back in December, their Kansas plant also tested positive for the bird flu, and that also impacted part of their flock as well. And what we're seeing here is two stories from CalMaine. Revenue came in lower in their previous quarter because prices are less than what they were a year ago. Of course, we know that they were accused of price gouging because of the higher prices they charge consumers. But at the same time, something interesting that they pointed out is that consumers are looking for these bright points, these cheaper protein options, and so they're seeing sales volume increase because consumers are heading towards or looking for cheaper protein options. But this bird flu impact, could we see prices go up again? That's what many analysts in the street are looking out for too.
We're big egg buyers in my household. What about you, Josh? You guys eat a lot of eggs?
Huge, a lot of eggs in the Lipton household.
Yeah, so I guess we're a little bit price agnostic because
it's a good bang for your buck. Breakfast for dinner, who doesn't love that?
That's a very good point. Thank you. Well, Costco and its healthcare partner Sesame are expanding into weight loss management. We'll speak to the CEO of Sesame about the move on the other side.
Yahoo Finance's Wealth is your guide, your group of advisors, planners, and jargon busters to help you save, build, and grow your money. How do I know if I'm saving enough for retirement? How do I know if it's right for me to go on that lavish vacation? Is it finally time to refinance my mortgage? How do I pay less in taxes? We'll get you the answers you need. Wealth, earning it, growing it, and managing it. It's more than tracking just the latest market moves. It's more than your favorite trending tickers. One does not simply build wealth without considering the entire financial landscape. It takes a community, and we've built one for you. Wealth cuts through the noise to help guide your financial decisions so that your money works for you. Wealth on Yahoo Finance premieres March 25th.
Costco and its healthcare partner Sesame are expanding into weight loss management. The warehouse retailer will begin offering its members in the U.S. access to weight loss programs and doctors who may prescribe users weight loss medicines like Ozempic or Wegovy. For what this means and what it means for the healthcare industry moving forward, let's welcome in David Goldhill, Sesame CEO. David, it's good to see you. So it's an interesting service here, David. It sounds like Costco now offering members this weight loss program, includes access to these drugs, Ozempic, Wegovy. 3-month service, David, through you all, Sesame, for $179. What do you get for that $179, David? Walk me through the service.
Sure. What we provide is clinical oversight of those patients seeking weight loss guidance and potentially programs. It may involve prescription medication. It may not. Obviously appropriate for some patients, but not all patients, and not even what all patients are interested in. For the 3 months that we cover for the $179, you have a choice of a physician who will oversee a program for you, evaluate whether prescription or other interventions are appropriate, and we'll oversee that during the 3-month period with constant communication.
And David, if indeed the patient is eligible, it makes sense for them to be prescribed one of these GLP-1s like a Wegovy or Ozempic. You don't accept insurance, if I'm correct here. So what are we talking about in terms of out-of-pocket costs for some of those drugs?
Excuse me, Sesame is not a pharmacy. So obviously Costco has a pharmacy and a patient can choose any pharmacy they want, should a prescription be appropriate here. The issue with the drugs is the same as I think everybody is facing, which is there is some insurance coverage, and to the extent that you and a Sesame doctor think that's the right course for you, we'll help with pre-authorization for those with insurance coverage. For those without, the out-of-pocket now is quite costly. And what we do there is help you find appropriate manufacturers' coupons or other programs that might be available. Sesame is a medical service, and Costco obviously is a pharmacy, and we're working together. But as I say, this is not just about the GLP-1s. Obviously, that's increased people's interest in weight loss programs. But again, only for some patients would that make sense.
Right. That point is well understood, and I hear you on that. I do want to ask you one more question on that front, on the drug front specifically, because platforms like yours and networks like yours, and I think this is something we've talked to a lot of people about. There is sort of this balance now between accessibility, because you want people to be able to get the drugs that they need, and supply, because there are some concerns about shortages of some of these drugs. So how do you think about that issue?
Well, I think that's right. I think it may well be that we continue to see shortages in the near term. I think the issue for the patient is it an appropriate treatment? And if so, it may be that there are other drugs that you use to titrate your way into the GLP-1s when they become available. Again, the emphasis on Sesame, I think it is very different than anyone approaching weight loss, is really on the personalization of a program, including as it relates to what pharmaceuticals are available today, if that's the right course. I think right now there's obviously a lot of excitement about the GLP-1s, and there's a view that we can at some point get through these shortages, but it is the reality of the marketplace now. And again, what we're trying to figure out is what patients this is best for and what patients can benefit immediately.
And David, let's say you're a Costco member and you signed up for this service, and as you say, it's a personalized sort of service, and you'd be meeting with these clinicians. Who are those clinicians, David?
So Sesame is a marketplace of physicians who accept direct payment, cash payment for their services, that for patients who are on high deductible plans or have limited insurance or are uninsured, Sesame generally offers a much, much lower price to see a clinician across a broad range of specialties. Weight loss is just one of the things we do, but across 40 specialties, Sesame clinicians, because they are direct pay, tend to work at much lower price for those patients. For the particular programs that we do with Costco and for Costco members, they have access to this cash pay marketplace at an even better rate. And that's something that we've worked on providing for Costco and its members.
David, it's an interesting program, and we thank you for walking us through it.
Thanks for the time today.
Thanks. Gasoline prices in the U.S. hitting the highest level in 6 months today. With more on what's driving that increase, we're joined by our Inez Ferre. So what's going on?
Yeah, Julie, we have gasoline prices now, the national average at $3.57. That's 7 cents higher than it was a year ago. In California, you are already seeing gasoline prices above $5 per gallon at $5.20 a gallon. That's about 35 cents higher than just a year ago. So we're looking at gasoline supplies that are looking tight in California. Also here on the East Coast as well, you've got stockpiles that are falling the most since March of last year. Over in the East Coast, you have stockpiles that have been falling the most since 2021. You have gasoline futures that are higher. I'm going to pull up the Wi-Fi Interactive really quickly for you so you can see the price action that we have seen with Brent and WTI today. Late in the session today, we saw WTI surging above more than $1, more than 1.5%, above $86 a barrel. Brent crude that closed above $90 per barrel for the first time since October. So besides the falling gasoline inventories, you have the underlying commodity, oil, which is going higher, guys.
Inez, thank you so much. Appreciate it. And that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
vision is to create a world with zero crashes, zero emissions, and zero congestion.
I think a crisis is the time you really demonstrate to the entire team you're going to live your values.
2024 is really a critical year.
The leader of one of the largest automotive companies in the world, General Motors CEO Mary Barra has her work cut out for her. Over a 100-year-old company, GM is facing a turning point in an industry racing into the future. From her early days as crisis manager to her recent change-making goals, Barra has made some big bets on where she intends to take the company. She promises to double GM's revenue by 2030, transition GM's fleet to be fully electric by 2035, and to have GM become the leader in autonomous vehicles within the next 5 years, overtaking Elon Musk's Tesla and thwarting longtime rival Ford. After being skeptical for some time on Barra's transformation plan, investors have started to kick the tires on shares of General Motors. We met with Barra at GM's Global Technical Center in Warren, Michigan, where we were given rare access to tour the campus in a new E-Ray Corvette. She reflected on her bumpy start at the helm of GM, the corporate culture shift she was forced to initiate, and how she plans to convince hesitant investors of her bold vision for the future.
Are you ready?
Yeah.
All right.
Let's rock and roll. Yahoo Finance had the opportunity to ride shotgun with Barra inside a new E-Ray Corvette, a car that required Barra and her team to take a gamble with a total redesign of the classic American sports car. She says it showcases what she believes will be the future of GM, electric vehicles. Will those moves translate into shareholder value, though? Despite previous headaches with EVs like the Bolt, Barra seems to think so. You're making bold bets on EVs. You have a great number of EVs. You envision an EV future. How do you deal with some ones that maybe haven't worked in the past? How do you deal with that feedback from the team and even shareholders?
Well, I think first is be transparent and be honest. With a company of this size, and again, when you're in the midst of the transformation, we're going to learn a lot. We're going to learn what works, what doesn't. We're going to learn what the customer really wants. And so I think you just have to be nimble and not. I mean, the worst thing you could do is stick with something when it's not working, and you find out there's a better way. And so, we learn and we make changes.
What did you see 10 years ago that drove you to this conclusion that GM needed to be all electric by 2035?
Well, I think, if you go back to EV1, I mean, GM was ahead of its time. And so we never stopped working on EVs and battery technologies. In 2010, we came out with the Volt, which was an extended range electric vehicle, and then the Bolt in the 2015 timeframe. But then again, as we really started to look at climate change, really started to understand where the regulatory environment was going, that's what led us to do the Ultium platform, where we could really provide, be able to do vehicles faster.
Although GM's revenue grew by 10% from the prior year, 2023 didn't come without challenges, as the company was forced to take a $1.1 billion production loss as a result of the UAW strike, something it's now carrying over into 2024 as it doubles down on its EV bet. It's been a challenging 6 months for the auto industry, or if not a bit longer, given the strike, the UAW strike. What did you learn as a leader going through that process?
We knew that it was going to be a very important negotiation. Clearly there was new leadership in the UAW, and we were just learning each other and had different priorities, so we had to do a lot of problem solving. So it was a difficult time, but we got through it. I've been involved in labor relations in one sense or another for 20 years. And our employees that are represented, and we have to talk and understand, again, sometimes we have different priorities, but how do we find the solution? Because we have to do what's right for the employees, but we also have to do what's right for the company, because without the company, the employees aren't going to have the job.
From her early days inspecting fenders at a Pontiac plant to becoming the first female leader of one of the big three automakers, Barra has already honed her leadership chops in a variety of ways, both intended and not. You took over as the CEO of GM at a very tough time, just following the bankruptcy of the company. Is there a different playbook to lead during a crisis?
I think a crisis is the time you really demonstrate to the entire team you're going to live your values. you're going to, do what you've been saying. It's easy to do the right thing, or it's easy to live your values when everything's going well. But really showing them, when it's tough, we're still going to do the right thing. We're still going to live our values. We're going to focus on the customer. All of that, I think that's what you've got to demonstrate. And when you do, it becomes much more ingrained. And people go like, okay, yes, I get it. They're committed. And that's so important when you lead a team the size of General Motors.
Was it really important then to be visible and vocal?
Absolutely. We needed to over-communicate. And we did. Not only myself, but several leaders. One thing that happens in a crisis is you learn you have an issue, but it happens, depending on what it is, over the next several days, several weeks, sometimes even several months of what really happened.
Barra never really had a choice about being visible or vocal. One of her first tasks in leadership tests was navigating the company through one of the most high-profile and damaging recalls to hit a major automaker.
I am deeply sorry.
Sorry not only for what happened, a faulty ignition switch that led to over 200 injuries and more than 100 fatalities, but for the internal culture that allowed a decade to go by before defective vehicles were recalled. A 325-page report made public after an internal investigation found a culture at GM that lacked accountability and ownership when it came to safety issues. The recall and internal investigation into how the company failed to address problems sooner forced Barra to change the siloed culture at GM to ensure an epic communication failure can never happen again.
How did you go about changing the culture at GM within those first 6 months on the job?
Well, it was a really interesting time because everything was being written. Mary Barra, can she change General Motors' culture?
The federal government today hit General Motors with the biggest fine ever levied on an automaker, the maximum penalty for failing to sound the alarm about a serious safety defect.
And not everything in our culture was bad, but it's a little bit daunting because when you read about culture change, people say it takes 5 years. What is a culture? A culture is what people think of the company. You can't fake culture, but what you can do to start changing the culture is change the way you behave. So as a senior leadership team, we said, okay, we're going to start living and demonstrating these behaviors, and if we aren't, we're going to respectfully call each other out. Thanks, Mary. Thank you all very much. Thanks for what you do. This is so important for the company. Thank you.
Changing and adapting how a company the size and scope of GM behaves is no small feat. Something Barra addressed with the ignition switch debacle, but is now addressing again in a different way, the company's future.
I gave it enough acceleration. We're out of stealth mode.
What do you think this car represents about your leadership?
First, when you talk about mid-engine, that was a vehicle that had, been discussed for years. Finally, we believed that we had taken the Corvette as far as we could and that we needed to move to a mid-engine. And so it was a big commitment because it was a big investment.
How do you ensure that these risks pay off?
We look at decisions on what product we're going to do, what features we're going to put in the vehicle. We put a lot of thought into how we do that. We do customer research, but then there's some things you can't research because sometimes it's, you just have to go with something you believe is going to be so spectacular and different and excite the customer.
The latest iteration of the iconic Corvette is certainly emblematic of going with something spectacular and different. The question is whether it and other efforts will be spectacular and different enough to convince consumers and shareholders that GM can go from American revolution to American evolution. Investors have put GM stock in the show me category amid volatile earnings reports the last few years. GM shares trade at a massive discount on a PE basis not only to the market, but relative to its highest profile rival, Tesla. GM stock is also trading at a big discount to what its own hard assets are worth, things like real estate and factories. Even a $10 billion stock buyback plan, something GM announced in late 2023, is a big sign that the company itself thinks its stock is undervalued and will be worth more down the road. Hasn't yet won over all the naysayers.
What is the most important thing you need to execute on to win over shareholders?
Well, we clearly have to demonstrate that the Ultium platform allows us to have a portfolio of profitable EVs that customers want to buy. Critical. That we have software in our vehicles that enables a better customer experience, an easier customer experience, and surprises and delights. And then that we craft the future path for Cruise. I mean, I really think it comes down to doing those three things well while delivering the financial results and doing the right thing for our owners, our shareholders.
which means not doing everything at once. That includes decisions like pausing all autonomous vehicle activities at the end of 2023 when one of GM's Cruise robotaxis ran over a woman, causing injuries. GM revealed the self-driving unit is under 2 federal investigations into the incident. Barra also announced on GM's latest earnings call the company is cutting spending on the Cruise division by $1 billion. Despite recent setbacks, Barra is still committed to an autonomous driving future.
Where do you see GM in 5 years?
I'm working hard to make sure we're leading in electric vehicles in the countries that we operate. I'm also very focused that we have software that creates a whole new customer experience. And then autonomy, when you think about self-driving vehicles, it really takes us to a safer place. Our vision is to create a world with 0 crashes, 0 emissions, and 0 congestion. And I hope people in 5 years say they've done that and they're in a leadership position because of it.
While Barra remains hyper-focused on keeping GM not only profitable but relevant and rolling in the 21st century, she still makes family a priority in her life. And yes, she tries her best to unplug at night.
I think every leader is different, but for me, I do need a little bit of a break because I think that, gives you, it allows you to have a fresh perspective. And I think you need to, not disconnect. You're still doing emails every day. You're always on call. I think is really important to get that break many times I've woken up with a fresh perspective.
A fresh leadership perspective that Barra hopes keeps a legacy automaker like GM competitive and successful in the uncertain years to come. How important is 2024 for GM?
2024 is really a critical year because this is a year of execution. And we really, we need to demonstrate, and, we're on track now. We had some challenges last year with building battery modules to put into the packs. We're on our ramp plan now. I'm really proud of how hard the team has worked. So this is a critical year, also a critical year for software. We have really brought in a new software team from Silicon Valley last year. And they've made a lot of change to improve how we develop software, to improve how we validate software. So this is definitely a year of execution, but I'm confident the team can do it, and I'm excited to show the world what we can do.